Okay, students. So yet again a video on partners loan account. One more adjustment, the last adjustment you can say in resolution. Now, loan taken from a partner will be passed through cash or bank account, even if the partner's capital account has a debit balance. That means loan taken from a partner. If the loan has been taken from a partner, we have to close it by giving through cash. That means firm has taken loan from the partner. The firm has to return back the money to the partner. It will not be adjusted with his capital account. But when loan given to a partner will be transferred to his capital account. That means loan given to a partner is an investment of the firm. So partner requires to provide that money. So when partner will provide that money, instead of that, it will be adjusted with his capital's credit balance. But if the partner has a debit balance, then he has to provide the money to the business. When accounts are prepared on fixed basis, partners' current account balances are to be transferred to capital account and no adjustments are required to be passed through current account. That we know. Anyhow, let's do with the loan. See the journal entries. A is loan in the liability side of the balance sheet. So when dissolution takes place, I have to debit it because liability, that means firm has taken the loan. So firm is paying back, so to cash. And if A is loan in the asset side, then firm is not going to receive any money, but it will be adjusted with A's capital account. Partner A's capital account debit to partner A's loan account. But suppose over here only, if the capital would not have been in the credit balance, then it would have been cash to A's loan. Okay, that we will do in the sum, you will understand. Partner A was allowed interest at the rate 10% per annum. So interest on loan, so interest, partner A was allowed interest. That means firm needs to pay this interest. It's an expense of the firm. So interest to partner A's loan account. Instead of interest, it is realization to partner A's loan account. And when A was charged interest, that means firm will get, it's an interest, it's an income to the firm. So two interest, instead of that, two realization, and partner A's loan account. Again, loan account will be debited to realization. The interest is charged from the partner. Something is coming into the business, is going to come in the business. So partner A's loan account, asset is increased to realization, the income part. Now let's do a sum, prepare loan account under this following 12 circumstances. Partner A's loan in the liability side of the balance sheet is 10,000. So what we will be writing in the loan account? We will simply write buy balance brought down 10,000, and as he will be paid, so it will be taken to cash in partner A's loan account. See, buy balance 10,000 and to cash 10,000 paid. In second case, partner A's loan liability side 10,000 and he was paid the same amount. It's written paid, not written then also paid. So entry is same. Partner A's loan in the liability side of the balance is 10,000 and was paid 500 less. So in this case, it will be 9,500 to cash, and to realization, the loss on payment or profit on payment rather is recorded because we are paying less. 9,500 is a profit on payment. This will be transferred to realization account. Any type of profit is transferred to realization account. Next, number 4. Partner A's loan in the liability side is 10,000 and he was paid 1,000 more. So liability side, first of all, we have to close. By balance brought down 10,000. We are paying 11,000 because we are paying 1,000 more. That means there's a loss. That loss is realization account 1,000. Instead of 10,000, we are paying 11,000. 1,000 more. Next is what? Next is partner A's loan in the liability side of the balance sheet is 10,000 and he was paid along with the interest at the rate 6% per annum. Partner A's loan in the liability side of the balance sheet is 10,000 and he was paid along with the interest 6% per annum. First of all, loan account needs to be closed and the interest account you have to make. So one more journal entry will come. That is interest account debit to partner's loan account or realization to partner's loan. So we have to open the loan account. So see in the loan account in number 6. So number 5 we have not done. Let's see number 5 first. Oh, number 5 only I was talking about. Interest 6% per annum. Now 10,000 6% is 600, but the date of loan is not mentioned, so it will be 300. So see, balance 10,000. We are paying along with the interest, so to cash 10,300, and that interest entry is interest to partners loan. So it will be realization to partners loan. So this is nothing but realization to partners loan. This is all loan account. All are loan account only. So in this loan account, you see buy balance brought down 10,000. Interest, that is by realization, 300, and to cash we are paying 10,300. Now see number 6. Partner is loan liability balance is 10,000. He has a debit balance of capital 8,000. Now here's a debit balance. So whether it is a debit or credit, nothing to do. So it will be transferred like this. Buy balance 10,000, to cash 2,000, and to capital 8,000. That means we are adjusting with the capital. The journal entry is happening as partner's loan account debit. How much we are paying him? 2,000. And as he has a debit balance, so it is loan account debit to capital, adjusted with that is capital only. So it's important. We have to adjust it with A's capital only, because we are not going to pay him 10,000 and again take 8,000 from him because he has a debit balance. Very common sense, this one, that he has a debit balance. So he needs to pay to the firm, but he was going to get from out of loan 10,000. So it's a readjustment. Only he has to pay 2,000 and the matter is over. Matter is resolved. And for that, the journal entry loan to cash 2,000 and loan to capital 8,000, 8,000. Next, number 7. Partner A's loan in the liability side of the balance 10,000 and has a credit balance of capital 8,000. Credit balance. Now, when credit balance is there, so that has nothing to do with his loan's liability. He will be paid that 10,000. So let's see number 7. Number 7. Okay, number 7 over here only. Buy balance brought down 10,000 and he has been paid to cash 10,000. He has a credit balance. Next is partner A's loan in the asset side of the balance sheet is 10,000. Partner A's loan in the asset side of the balance sheet is 10,000. Asset side of the balance sheet. Now we have left with liability, now asset side. No other information. We will open a loan account and we will write to balance brought down as no other information. That means we are not going to receive any money. So it will be by realization only. Let's see what we have done with this. Say students, generally in the case of liability, in the case of asset, if nothing is written, then we don't realize anything. But in case of partner's loan, it's an asset. He has a debit balance of 10,000 investment the firm has done. Partner needs to pay it. So it will be adjusted with his capital. We assume that he has a balance in his capital. So we will be writing by capital account. Capital account debit to partner's loan account. We are closing this loan account in partner's capital only. In the loan account, we will write by capital. Number 9. He has a debit balance of 10,000 in the investment and his closing capital in the credit side is only 7,000. So 7,000 he will be getting adjusted with capital. That means he will be his debit balance will be cancelled off with this credit balance of capital. That means capital account debit to partner's loan account. We will be writing capital account debit to partner's loan account. Again, I say we will be writing. See on the board. It will be better to show it on the board. So see the journal entry, students. It's written over here. Capital account is debited by 7,000. See over there, capital account debit 7,000. And then we have bank account debit 3,000 to investment 10,000. Now why bank account debit 3,000? Because from the partner we will take 3,000 in cash or through check or whatever, and 7,000 is adjusted with his credit balance of capital. Now this was number 9. Now number 10. Partner A's loan in the asset side is 10,000 and his closing capital in the debit side is 7,000. Now see the situation, debit balance in his capital. So if the debit balance capital means nothing can be adjusted as such, if nothing can be adjusted means entire 10,000 he has to bring. So see, being debit balance as his capital, so entire investment value of 10,000 to investment 10,000 is debited, is credited to get cancelled, and money is received for that 10,000, and that 7,000 balance, that capital debit balance, that also will be received by him. That means we have passed a compound journal entry, bank account 17,000 debit, to investment 10,000, and to capital account which has a debit balance will be credited now 7,000. Now see the ledger of this one, students. This number 9's ledger. By capital 7,000 and by cash. No, this is not number 9. Some mistake is there. One sec. Ledger account, no, it was number 10. So we have written to balance 10,000 and by cash 10,000. We have not shown the capital money received. That is, if you would have opened the capital account, then I would have written to balance 7,000, by cash 7,000. And number 9, there was a debit balance of 7,000 in the capital, credit balance of 7,000 in the capital. That's why 7,000 was cancelled out from capital only, and the remaining amount we have received from the partner as 3,000. Number 9's ledger account. Partner's loan account only we are doing. Now we will see number 11. In number 11, partner A's loan asset side 10,000 and he was charged interest 10% per annum. So when we charge interest, journal entry is what? Interest account debit. Charged interest, that means we are receiving, that is the business is receiving interest from him. So partner A's loan account debit to interest on loan. Let's see this one first. See students, the journal entry for this one is partner's loan account debit 500 to interest on loan 500. Now interest on loan we don't record. We say this one as realization account. What do we say? Realization account. So as it is a realization account, so in the realization account we will write by partner's loan 500, and in partner's loan I will record to balance brought down, and then we will be recording to realization. See, and then we will receive the payment, and if payment in the form of capital also we can write by capital. To balance brought down 10,000 to interest realization, see 500, and by capital is adjusted with his capital. Now we will do the last one and then I'll give you the homework. See, partner A's loan in the asset side of the balance is 10,000 and he paid interest 10% per annum. Along with his loan amount, he makes the payment. That means you have to understand that he has maybe a debit balance, or when it is mentioned over that he's making the payment. The partner is making the payment. First of all, we will pass the same entry for this interest. Interest, same entry we will pass. Partner's loan account debit 500 to interest on loan, that is realization 500. Then we will show in the partner's loan account, we will show the to balance brought down 10,000, to interest, that is to realization 500, and as partner is paying the money, instead of capital we are writing by cash, as it is mentioned over here in the sum, that he is paying the money. So students, we have understand now that how to prepare the loan account, whether it's the debit balance the loan balance has or the credit the loan balance has. Now homework, this is the homework. You can send me in my email ID also, Sanjiv.Sirjii, the same name, @gmail.com only. You can send me in the email ID. I will be happy to check it. Or you can also send me through WhatsApp also. Definitely, I will be coming to you and I will be solving it out, and I will be letting you know the answer. You must check my descriptions also. Okay. Anyhow, how it gets benefited, you do that. Thank you, students.